Right, right. Okay, well, let's get into this area of real estate now. Um, why would someone want to invest in real estate through an IRA or a Roth account?
Well, it's like any other investment. They have a feeling that that they understand that this particular choice that they're making on a real estate investment has the potential for income and or appreciation. They're going to have to do their own due diligence or work with a broker. In many cases, our clients are actually real estate professionals, so they see the market all the time.
Mm-hmm.
But just like might be picking a stock, they're deciding that this particular real estate investment is a good opportunity. Then again, there's something called asset allocation and modern portfolio theory. And by definition, the modern portfolio theory suggests that everybody should diversify their portfolio into non-correlated asset classes. Not all in the stock market, which is correlated generally, but when you introduce real estate or even cash or foreign stock or gold or silver or things like that, all of those have their own characteristics as to how they respond to economic conditions. And generally, they don't respond simultaneously. So by mixing those different asset classes into a single portfolio, you have a hedge against each class.
Mm-hmm.
So if one's going down, another one's going up to offset it.
Right.
And actually, Harry Markowitz was a Harvard professor that created the modern portfolio theory. And he received the Nobel Prize in Economics in 1990 for it. And generally, nobody's refuted it. And it's a probability analysis mathematical equation he put together that essentially established that there are 21 different non-correlated asset classes. And if you were to spread your chips like you were in Vegas across all these asset classes, you virtually would not lose. One would balance out the other. And quite frankly, when you take you take an intelligent target shot at each asset class, trying to pick a good investment within that class, your odds are that you're always going to make money.
Mm-hmm. Okay. So again, when we're talking about correlation and so forth, part of the benefit of diversification is that when one class is going down, we like to always focus on the positive. So if one is going down, the other one's going up, or you could say when one's going up, the other's going down. But anyway, trying to smooth out the line, if you will, and hopefully everything's averaging out up.
Yeah, the simple way to look at it with real estate is if all of a sudden something significant in the global economy occurred overnight while you were sleeping, you may wake up in the morning to see that the stock market is off by 10%. Mm-hmm. But your 2 acres in Idaho are really not affected by that, because what will affect the 2 acres in Idaho is whether there's any demand for real estate in Idaho, not what's going on in Japan or something.
Yeah. Now another thing, here we are, today is February 23rd, 2010. Let our viewers know when we're recording this. And that is that in the real estate market right now, there's a lot of, if you will, bargains that are out there. And so that makes it attractive also, as far from a timing standpoint. It seems like this is a good time to be thinking about getting into the real estate
unfortunately,
market.
one man's sorrow is another man's opportunity. And while residents in many cases are being foreclosed on, losing their job or whatever, not being able to pay their mortgage, that's putting properties on the market that are depressed in terms of value and or are taken back by a bank, which is called real estate owned or REO properties. And generally, banks will liquidate these at below market value just to get them off their books, because they have an increased capital requirement to carry those assets. So when an investor has liquidity, they step in and they can get real deals right now.
Yeah. And there's one other thing, and that is that for most individuals, most of us have kind of anemic savings accounts personally, but we have a pretty good pool of money that may be available in our IRA, especially again when we get these rollovers from the employer. That's where the big money comes in.
Oh, absolutely. I've seen secretaries retire with $300,000 to $400,000 out of major firms.
Yeah.
So there are a lot of, if somebody works there 30 years and they've got a good matching policy or whatever, you can accumulate an awful lot of money very quickly.
Yeah. Okay. So we talked a little bit about the diversification. So let's talk about maybe some other advantages of investing in real estate using an IRA or Roth and some of the things that are available.
Well, there's a general concept, unfortunately promoted by most CPAs, that it makes no sense to buy real estate in an IRA, and that I happen to think that's terribly false and a misleading and a disservice when that's communicated. Essentially, there are a lot of advantages to buy real estate in an IRA. Number one, when you buy real estate all cash with an IRA, you can buy it in the morning and sell it in the afternoon without a 1031 exchange, which
Right.
avoids the cost of a 1031 exchange, the complexity of it,
Yes.
and allows you to capitalize on opportunities that are really amazing. When Las Vegas was hot, we actually saw somebody go to an auction, buy a property, and go to the back of the line and sell it for a profit.
How about that?
2 weeks ago, I had somebody use a real estate broker in Phoenix. They bought an REO property for $54,000 and sold it the same day for $85,000. And the
amazing.
broker found both sides of the transaction and took a cut, but still.
Uh-huh.
So that kind of, you can get some velocity that you can't get otherwise. Furthermore, when you have rental income on a property that you might buy, if it's all cash, the purchase was all cash, all that rental income comes in and compounds in
Yes.
terms of earnings.
Yeah.
That's not the case if you buy with taxable funds. You're going to be paying income tax on that at the end of the year. And the other thing is there's ability to use leverage with an IRA that many people are not aware of. So you can actually use an IRA to make a down payment and get a loan from a traditional bank for the balance, just like you would on your own residence. Although the down payment is generally a little more, a little larger in the sense of about 30 to 35%.
Okay.
But when you actually have income there, you are going to be paying some tax, and you're also going to pay some capital gains if you sell a property with leverage. However, you're going to be paying less because you only pay tax on the portion that is leveraged. So if you had 30% down, instead of paying 100% tax as you would on any gain or income on a taxable real estate investment, you're only going to be paying 70% of any income tax or capital gains. And by the way, when you sell, as long as you hold it for 1 year, a property that's leveraged with an IRA, you're only going to be paying the long-term capital gains tax, which is 15%
Right
at this
now.
point. Yeah.
Probably 20% next year. We'll
Yes,
see. We'll
probably.
see. So, yeah, so there are these opportunities. Some people don't realize that these accounts can be subject to income tax themselves. So,
Well, if you're using money
yeah.
that is not part of the IRA, mainly a bank loan or a third-party seller carryback or even a hard money loan from somebody else, you're using somebody else's money and you're generating income, the government's going to tax you on that.
Yeah.
And it's called unrelated business income tax.
Yeah.
When it's capital gains, and it's called unrelated debt finance income tax when it's income on debt financed property.
Right. And so, and it doesn't have to be leveraged if you're conducting a business in the IRA. So, and that's a little bit of a gray area.
Yes,
So,
that's another matter
yeah,
altogether. Now,
yeah.
you can actually own an entire business. So you could own a pizza parlor with your
Yeah.
IRA. The IRA is a sole shareholder. If you held it through a C corporation, then there
Right.
wouldn't be any tax to the IRA. If you held it in a passive vehicle like an LLC, then the IRA would be subject to unrelated business income tax.
Okay. So we got to move along here because time is going. So